So what I wanted to do in this video is to show um, the relationships between funds rates and 10-year rates and recessions, uh, primarily to explore this from a data analysis perspective. And one of the best areas to look at data analysis and data patterns for analysis are the financial markets. So I'm gonna show three slides and comment on them. So this is the first slide that I wanted to show, and as you can see here, this is a graph that shows the Fed funds rate over time, and as you can see, almost always, and this goes from early 1990 to 2022. So this is a more recent period. And as you can see, whenever the Fed raises its Fed funds rate, uh, soon enough we have a recession. So these shaded areas here are recessions. This is the most recent COVID recession. So we are now in June 2022, and this is when this video is being made. So this period here was one in which the Fed raised rates here, and then we had a recession, and then the Fed reduced Fed funds rate to stimulate the economy, and then it raised again because inflation started picking up. So the Fed increased interest rates up to 6% or so. Then its inflation started going down, so then the Fed reduced interest rates and kept them at this range above 5%, then reduced again because, again, the inflation rate suggested that this could be done. Then inflation started picking up again, and then the Fed started increasing interest rates, and then we had the 2000 recession. So one could argue that this increase in interest rates, in the Fed funds rate, which is the rate that the Fed can most readily control in the United States, that the increase in Fed funds rate up to a certain level tends to precipitate recessions soon after, and then the Fed reduces the Fed funds rate in order to stimulate the economy and get us out of this economic slowdown and into a period of economic growth. Then we have inflation again. Then the Fed funds rate is increased. Then we have another recession. And so the cycle goes. This one was an increase in interest rates that the Fed was doing preemptively. And this is the COVID recession. So one could argue that we would have a recession one way or another, but the trigger ended up being COVID that precipitated us into a recession, but that we would have a recession regardless because the Fed tightened, increased the Fed funds rate up to a point. Now, one thing you can see from this graph is that the levels at which the Fed funds rate precede a recession tend to go have been tending to go down over time. So this is the level here above 8%. This is the level a little bit above 6%. This one a little bit above 5%. This one in 2018 we got to not even quite 3%. And now the Fed is raising the Fed funds rate again. Let me go to the next slide. So in this slide, what I have is a trend line that tries to approximate this phenomenon, which is that the Fed funds rate that tends to precipitate a recession, uh, is going down. The level seems to be going down. So, and this line approximates this trend downwards. So, if this trend line is to be obeyed or to be followed, if this trend line suggests that there is a trend that's like to repeat itself soon, then we have some way to go in terms of funds rate increase. And this is actually before this measure here is before the most recent rate increase that took us more or less here. So if this historical trend repeats itself, we are getting very close already now as this video is being made in June 2022. So we're very close to the point where we would see a recession following. Now, this in blue here, what I have is the Fed funds rate, and in orange, it's the 10-year uh, Treasury yield, or the 10-year Treasury interest rate paid, the interest rate paid by the 10-year Treasury. So this Treasury, as you can see, it tends to follow the Fed funds rate. And I have another graph here, that's third graph that I wanted to show. So the 10-year rate tends to follow the Fed funds rate. But as you can see, it it does, in some cases it does move ahead of the Fed funds rate. So in this case here, they're moving, the 10-year is moving a bit ahead of the Fed funds rate. So this is the bonds market telling the Federal Reserve that they need to do something, and then the Federal Reserve does it. And this is a trend that you often see. So again, the 10-year Treasury rate is moving before the Fed funds rate. So this is again the bonds market telling the Fed that it needs to act. And this is what's happening now. Now, what's interesting about this pattern is that for the 30-year, I'm sorry, 10-year rate, uh, the line here is the historical trend uh, of the 10-year rate that seems to precede a recession. And as we can see, it has already gone beyond the level that we would expect if this trend line, if this historical pattern of uh, lower and lower rates precipitating recessions repeats itself. And now we're above it. What this may suggest is that we've gone already, the bonds market is already tightened for the Fed to a point that will induce a recession, and the Fed is catching up. Now, the interest, and again, the Fed funds rate is about here, so it's about at the point where we would expect a recession, given the trend in the blue line, which is lower. So it'd be a little under 2%. We're close to that already. And for the 10-year, we are above that point at which we would expect a recession to come soon. Now, the counter argument, and always an argument, since no one can predict the future, and not always historical patterns repeat themselves. There is always a counter argument, and usually more than one. The counter argument here could be that as we go forward, the rates at which we will see a recession soon after may go up. Another possible scenario is that we are going to have a recession, but rates will remain elevated. Um, the other possible scenario is that we're not going to have a recession and rates will remain somewhat elevated. And should recall that this is what happened here. So what happened here was that the Fed raised Fed funds rates around this period of 95 and 94 95 to control inflation. The market told the Fed that he had to do it, the bonds market. And so the Fed did it. And there was no recession soon after. The recession happened around here in 2000. So there was no recession here. So we had something akin to a soft landing in this period. This may happen here as well. Based on the uh, uh, the historical pattern and the fact that we had multiple recessions in this period, it looks more likely that this is going to precipitate a recession. And because this is well above the trend line, this could be a severe recession. So this would be a possible scenario as well, and a not particularly optimistic scenario, but it could happen. And the data is telling us that is a quite a possible scenario going forward. So this concludes this demo on Fed funds rate, 10-year interest rates, and recessions.